Trump has released what he calls a cheating list. It warns countries against non-tariff barriers.
Trump is furious, and he's about to blow up global trade again. After discovering that countries are finding loopholes to dodge his tariffs, he's now accusing them of outright cheating and promising a brutal crackdown. We could soon see a new wave of aggressive actions from the White House against these so-called cheaters. Meanwhile, the US dollar is in big trouble as it continues to crash in value. There is a growing lack of confidence in the US dollar, and countries are moving to gold instead.
Another warning sign is the price of gold hitting another record high, topping $3,400 an ounce. The US dollar also heading in the opposite direction, hitting a 3-year low today. It makes buying things more expensive for Americans.
The implication of this crisis is very serious and could lead to an economic disaster that will affect all Americans. What's happening right now is unprecedented. Make sure you're subscribed so you don't miss the full story as it unfolds. First, let's dive into Trump's latest accusations. In a stunning escalation of his long-running trade conflict, former President Donald Trump has launched what he's calling Phase 2 of the U.S. trade war, an aggressive and wide-reaching campaign to target what he claims are non-tariff cheating tactics used by America's trading partners. The announcement, delivered during a high-profile weekend rally, introduced a new cheating list aimed at cracking down on a broad array of foreign economic practices that have long been accepted, even institutionalized, within global trade systems. Trump's list includes practices such as currency manipulation, export tax rebates, domestic subsidies, dumping of underpriced goods, protectionist technical standards, agricultural supports, intellectual property theft, and even so-called trans-shipping, where goods are rerouted through third countries to bypass existing tariffs. Though none of these are new concerns in international trade, what makes Trump's move remarkable is the sheer breadth of what he is demanding be dismantled and the speed with which he wants compliance. According to Trump, these aren't just unfair trade practices. They are acts of economic warfare, and the days of America being the sucker are over. But behind the applause lies growing unease. Economists, diplomats, and trade officials warn that the president's strategy risks upending the fragile foundation of the global trading system. Many of the targeted policies, while controversial, are deeply embedded in the domestic political and economic structures of other countries. Reversing them would not only be politically difficult, it could prove economically disastrous for the nations involved. Take India, for example. Trump's call for the abolition of agricultural subsidies hits at the heart of a system that supports nearly half of India's population. Unlike the United States, where only about 2% of citizens work in farming, India's rural economy remains central to both its development and social stability. Asking Indian leaders to abandon these support systems is widely seen as not just unrealistic, but dangerous. Subsidies in developing nations are not simply about trade, they are about survival. The asymmetry of Trump's demands is at the core of growing international frustration. His one-size-fits-all approach to trade fails to account for the economic diversity across countries. What may be an unnecessary subsidy in the US could be a critical safety net in the developing world. Yet Trump continues to frame the issue in stark, uncompromising terms. Either countries play by his rules, or they face tariffs, sanctions, or exclusion from the US market. According to several leaked reports and interviews with trade officials, the United States under President Trump is quietly offering deals to countries around the world. If a country reduces trade with China, it may get relief from US tariffs. This has been described by economists as a new kind of pressure tactic, one where loyalty to the US brings financial benefits and continued business with China brings punishment. The Chinese government is not taking this lightly. In strong language, Beijing has warned smaller countries not to take these deals. Chinese foreign ministry officials said those who work against China should be prepared to face consequences. This marks a sharp turn in what was once a simple trade disagreement. It is now shaping up to be a global economic fight where smaller countries are caught in the middle. The key question many are now asking is this: are you with the world's biggest consumer market or with the world's biggest manufacturer? For smaller countries, it's a risky choice, And making the wrong move could cost them a lot. In this growing conflict, attention turns to Southeast Asia. The 10-member ASEAN group, which includes Vietnam, Indonesia, Malaysia, and the Philippines, has become a major trade partner for both China and the United States. Between 2010 and 2023, ASEAN's trade with China rose in Q1, with Chinese goods pouring into their markets and factories in the region, booming with exports to China. However, the Trump administration wants more than just trade moving away from China. It wants factories and jobs to move back to American soil. U.S. trade officials are urging companies to stop using Southeast Asia as a substitute for China. They want production to return to the U.S. altogether. This puts ASEAN in a difficult spot. For example, Vietnamese exports to the U.S. grew 17% in 2024. But in March 2025, Washington still threatened new tariffs on Vietnam, accusing it of being a backdoor for Chinese goods. This shows that even countries trying to stay neutral are not safe from pressure. If the United States is determined to reshape global supply chains, ASEAN nations may soon have to pick a side. For now, they're trying to balance. But how much longer can they walk this tightrope before being forced to fall? While all these are troubling enough, the crisis takes on a deeper meaning. Business is no longer the battleground. Now it's about power, trust, and who sets the rules of global trade. The United States is accusing China of using unfair tactics, like stealing technology, manipulating currency, and forcing smaller countries into bad trade deals. China, in return, says the U.S. is trying to dominate the world economy by force. This battle is now being fought far beyond Washington and Beijing. Countries like Indonesia are being courted by both sides. In January 2025, Indonesian leaders confirmed that American officials had offered better trade terms if Jakarta reduced its imports from China. Soon after, China canceled a major infrastructure loan meant to help expand Indonesia's railway system. This pattern is repeating in many countries. Help the U.S. and lose Chinese investment, or help China and face U.S. tariffs. The World Trade Organization, once seen as a neutral place to settle trade disputes, is now being pulled into the fight. The U.S. wants new rules that favor democratic countries and punish those seen as helping China's agenda. In response, China is promoting its own trade agreements through the Belt and Road Initiative and its new international court system for trade conflicts. If this continues, experts fear the world economy could split in two. One side might use American rules, American dollars, and Western technology. The other side could follow Chinese rules, use China's digital currency, and rely on China's networks for trade. Already, China's digital yuan is being used in more cross-border deals, especially in oil trades with Russia and parts of the Middle East. The US dollar is still strong, but the challenge from China is growing. Talking about the US dollar, there is currently a strong shift against the dollar and towards gold. Interestingly, the US dollar is experiencing a significant decline in value, while gold prices are soaring to unprecedented heights. This shift is causing alarm among investors and policymakers alike, as it signals a potential loss of confidence in the US economy and its financial instruments. The dollar has depreciated by over 8% in 2025, reaching its weakest point in nearly 3 years. This decline is attributed to a combination of factors, including the implementation of sweeping tariffs by President Trump, which have destabilized traditionally safe investments such as treasury bonds and the US dollar. In response, investors are turning to gold as a reliable store of value, driving its price to a record high of $3,500 per ounce. The surge in gold prices is further fueled by central banks diversifying their reserves away from the US dollar. In 2023, central banks added 1,037 tons of gold to their reserves, marking the second highest annual purchase in history. Now the trend is back again, and gold seems to be the hottest asset now. This trend is expected to continue, providing sustained support for gold demand and prices through the next 5 years. The situation is further aggravated by the rise in US Treasury yields. The yield on 10-year bonds has climbed to 4.3% since October of last year. In January, it even reached 4.8%, coming close to the October 2023 peak of 5%. This signals a sell-off of government bonds amid growing fears of inflation, political instability, and rising national debt. A rising yield on U.S. Treasury bonds might sound like a good deal for investors. More return on their money. But for the U.S. government, it's a warning siren. When Treasury yields rise, it means the U.S. government has to pay more interest to borrow money. Just like a higher credit card interest rate drains a household budget, a higher yield on treasuries increases the cost of servicing the national debt. In 2025, as U.S. debt surpasses $36 trillion and continues to rise, even a 1 percentage point increase in yields could add hundreds of billions of dollars in extra interest payments over time. This extra burden constrains the government's ability to fund other essential programs, like defense, healthcare, and infrastructure, unless taxes are raised or spending is cut. In essence, higher yields make fiscal policy more rigid and dangerous. When yields go up, it's often because investors are dumping treasuries. That's exactly what's happening now. Foreign countries, once the largest buyers of U.S. debt, are pulling back. China, Japan, and oil-rich Gulf states have been slashing their holdings. Why? Because they're losing trust in the U.S. as a safe store of value. The reasons are many: unchecked inflation, ballooning deficits, political dysfunction, and an unstable currency outlook. If these sell-offs continue and the U.S. Treasury has to roll over maturing debt at these elevated yields, the debt spiral could accelerate. Imagine refinancing a $1 trillion loan at 5% instead of 2%. That's an extra $30 billion annually, just in interest. Early reactions have been swift and uneasy. The European Union issued a cautious statement, urging Washington to refrain from unilateral judgments that violate the spirit of WTO negotiations, while China signaled potential retaliation if Trump returns to the White House and enforces his new measures. In India, the Ministry of Commerce has already convened an emergency session to consider defensive steps. Trade experts warn that Trump's frequent use of exaggeration and misinformation is eroding trust among America's trading partners. The danger, one analyst noted, is that other countries stop taking the United States seriously. Or worse, stop negotiating altogether. Trump's aggressive rhetoric may rally his political base, especially manufacturing workers and small business owners left behind by globalization. But critics warn the real economic fallout from these confrontational policies often lands hardest on American consumers and exporters. During Trump's first term, tariffs drove up import prices and inflicted heavy losses on Midwest farmers caught in China and Europe's retaliatory fire. Now, with inflation raging, supply chains strained, and global tensions high, a fresh wave of trade wars could push entire industries to the brink. At risk is far more than just short-term trade deals. What's at stake is the future of American economic leadership. For decades, the U.S. shaped the rules of global trade, building alliances that anchored stability and growth. But Trump's second wave of trade wars risks shattering that foundation and isolating the United States from the very system it created. Across the globe, countries are moving quickly to stitch together new regional alliances. From China's Regional Comprehensive Economic Partnership to Africa's Continental Free Trade Area. The fear now is clear. The U.S. could soon be locked out of critical supply chains, key markets, and emerging blocs. In a world increasingly shaped by multipolar power centers, economic isolation could come with devastating long-term costs. What happens next hinges not only on Trump's political future, but also on how America's trading partners choose to respond. They now face a brutal dilemma: yield to U.S. demands and risk domestic political backlash, or resist and risk losing access to one of the world's largest consumer markets. Either path comes with steep costs, and as Trump doubles down on his combative stance, the global trading system stands at a crossroads, one that could define the next decade of economic stability or volatility. The question haunting foreign capitals and financial hubs alike is simple, chilling, and urgent. If this is just phase 2, what on earth will phase 3 look like? If you find value in content like this, make sure to subscribe for more deep dives into the shifting global economy.